This is a chicken or the egg question, right? What came first, chicken or the egg? Because the strategy solves the behavioral problem, but you need the strategy because the behavior exists.
Good point. So, I guess you need the discipline to stick to the strategy.
I just saw your face. You're like, I'm so confused right now.
I looked confused. I look confused often. So,
welcome to the Fiscal Foxhole, the podcast proving you don't need a degree in finance, just some grit, a game plan, and maybe a sense of humor. Your hosts are retired Army veteran Rob Moore and retired Marine veteran Omen Quelvog. Together, they'll help you dodge financial landmines, call in the air support on your savings, and laugh at the ridiculous money mistakes we've all made. If you can survive mandatory fund days, you can survive personal finance. Welcome to the Foxhole.
Greetings, budget buddies. It's Wednesday once again, which means it's time to welcome you back into the Fiscal Foxhole. I'm your host for today, Rob Moore, and joining me, as always, is the newly minted father-in-law himself, Omen Quelvog.
That's right. I got a daughter-in-law, but pretty happy about that.
Exciting. Yeah, so it happened this past weekend, right? So obviously, I say this all the time, like we're recording ahead of time. I'm just going to stop saying that. So anyway, but last weekend, your son, you married them, you officiated, and the newlyweds are off on their, well, you mentioned it wasn't much of a honeymoon at all. He's going straight back to work.
No, they let's see, as of when this podcast hits the ground, they are probably packing up the last of the boxes that are going to go in the U-Haul before he flies back to New Mexico and she drives to New Mexico from Virginia. She will have help. She will have help. That very first PCS experience, like she's all in.
Wow. Well, if she didn't have cold feet at the altar, then maybe now, like loading up I'm going to drive this thing across the country.
Yeah. I mean, that's pretty intense. Like, I'm trying to think of a spouse's very first move to the military. How bad could it be? I mean, driving across the country, that's probably up there.
It's probably up there. In fact, you know what, though? It might actually kind of, I guess, set the expectation for future PCSs, because from now on, if they don't do a Diddy move and they do the government supplied movers, then it's going to feel like a piece of cake. So every 3 years from now on, she's like, this is nothing. I had to drive a U-Haul across the country.
That's right. No, it's just one more story added to their stories of weddings and military moves and everything else that they have in life. So they're off to a good start.
Well, plus, and it also gives her something to hold over his head for at least 50 years. At 100%. Least.
But she's already getting back at him for this drive that he has to fly the cat back to their house. 12-year-old cat, by the way. So all prayers for him and the cat to make it to Mexico.
Well, hold on. Well, now I have a whole other set of questions. Where was this cat before?
Well, it's her cat.
Oh, it's hers. Oh, okay. I got it. Okay. For some reason, I thought in my mind,
all the boxes are going. All the boxes.
In my mind, I had pictured him bringing the cat back for the wedding. Like Jinxie Cat bringing the rings,
Oh, yeah. Well, trust me, there was no cat involved in grabbing the rings, but we're going to save that one for off duty.
Is there a story there?
There's a story. There's a story behind the rings. Okay. So
all right.
This is not your everyday wedding event with the rings.
Well, I'm excited to hear that. Unfortunately, we have a lot to get through before we can listen to that fun story. Before we jump into today's episode, just our weekly reminder, please, if you love our stuff, if you love the podcast, please take a moment and review. 5-star, please. If you like it, if you don't, then maybe find another one that suits your needs better. But just please take a time to drop a review. Also, we haven't advertised our firms on this podcast in a long time. We're sponsored by the MFAA, so we're talking about them in the commercial in the middle of the episode. But, I think it's a good time at some point to always just remind folks that we are taking clients. Both Omen and I run fee-only RIA firms. We have financial planning firms in Virginia, but we serve people nationwide. So if you're interested in discovering more about how our firm might be a good fit for you and what you need, then please check the show notes for links on how to get in touch with us. Well, with that behind us, I do want to take a moment just to tease what we're going to talk about today. Today is all about discipline in investing, which if that's a new concept for you as a listener, if you're more of the type that you hear the financial noise and buy, sell, and the fast action, if this idea of discipline in investing is new to you, I encourage you to really dig in with us here in the Foxhole and check this one out. It might go long because I think there's a lot of good points to be made about discipline in investing. And for someone like you and me, Omen, and I don't mean to speak for you, but I feel confident I can in this regard, is those are two things that go hand in hand.
Yeah, I'd 100% agree that discipline in investing, and I'd also add in there intentionality as well in your investment plan, will go a long ways to make you successful. Like there's no guarantees here on the show in investments, right? But we look at historical trends, and within those historical trends, the ability to be, number one, intentional about how you invest, but number two, sticking with that plan. So the discipline to actually stick with that plan will give you the best chances at being successful in investing.
Right. And we've talked about before, when does investing turn into gambling or speculating, right? And I think when you remove the discipline, that's kind of the first pillar to fall when we're sliding more towards the speculative side. So today we've lined up, 5 good points about why discipline in investing works, why it's critical, why you and I plan that way with our clients. We message this constantly with them. But before we jump into all that fun, we have 2 items to take care of, first of which is today's date in military history. Keeping with the theme of the nation's 250th coming upon us here in a few weeks, this date comes to us from the American Revolution, June 17th, 1775. That was the day where the colonial militia had dug into the hillside outside Boston and changed the course of the revolution. Omen, on this day, the British had 3,000 professional soldiers squared away to face our revolutionary militia, of which the militia had muskets, not much ammunition, not a lot of supplies to face off this professional army. When the Redcoats finally marched up Breeds Hill, Colonel William Prescott from the Revolutionary Militia gave the order, "Do not fire until you see the whites of their eyes." So after that famous line, the colonists then repelled 2 full assaults from the Redcoats before running dry and running out of supplies, and they had to retreat on their 3rd assault. Now, the British, technically, they won that battle. They took the hill, but they took over 1,000 casualties doing it. And later, General Clinton from the British military called it a dear-bought victory. So this is the battle that proved that untrained militia could stand toe-to-toe with the most professional army in the world.
It's funny seeing the parallels between that and today, actually, where we have maybe some not as well-trained militias that are somehow having a significant impact against those that are well-trained, well-equipped.
I have no comment on that. I'll let that sit. I had a different thought with this, and that's like every Memorial Day, and every time we talk about history, we talk about these men that stood up and they died, right? Yeah. And this is coming from the perspective of like, we're 250 years on. Like, we know the history of the country, and this was worth doing. But man, that was like a new idea back then. Can you imagine like now coming up with like, hey, we've got this idea for our country. It's never been tried.
That's right.
Okay. It's a really cool idea. We think it'll work, and we don't like the way the British are treating us. So we're just going to create this new idea, this new system out of whole cloth, and we're just going to give it a shot. Meanwhile, oh yeah, by the way, you might have to die for us to start it. And there's no guarantee that it'll last.
It's actually going to take off. Yeah, that's right.
Yeah. I mean, I know that's obvious, but I don't ever really think about it like that, like put myself in their shoes. So this part of the journey over the 250th, that makes me feel, I don't know, it just makes me feel connected and grateful for what they did back then. Anyway, I could talk about the 250th and everything coming up for too long, so I will leave that alone and move on to today's headline. Today's headline comes to us courtesy of the Motley Fool and author David
Durkin. Come on, man.
Durkin. I don't know this one. Do you know that author? Well,
I've heard of him before.
Oh, okay. I felt bad. I'm like, maybe this is someone I should have known, but I didn't know how to pronounce the last name. I have to stick with it. Infamously, I can't read last names when it comes to the news segment. But anyway, David wrote an article entitled "The One Costly Mistake Too Many Investors Make with the Vanguard S&P 500 ETF," otherwise known as ticker symbol VOO. Reading from the article, the S&P 500, despite its diversified simplicity, has become one of the best investments over the past decade. Over the past 10 years, the Vanguard S&P 500 ETF, VOO, which tracks the well-known index, has generated a total return of 327%. That's not quite as good as many tech and growth exchange-traded funds over the same period, but a 15.5 average annual return from a diversified basket of large-cap stocks is really good by almost any measure. Yeah, I mean, really good? That's exceptional. I mean, would you take a 15.5% return over the next 10 years?
100%. Yeah, I mean, like 100%.
Really good. It's remarkable. It's no secret. I mean, anyone in the S&P 500 knows, especially the last 10 years, been really, really strong. But that's not the heart of what he's getting at. He continues, the truth is that the index is as overweighted tech today as it's ever been. With a 35% tech allocation, the S&P 500 looks less like a fully diversified portfolio and more like a tech fund with other sectors sprinkled around the edges. Omen, your thoughts?
This is a problem, right? So you just asked me if I would take a 15.5% annual average over the next 10 years. And of course I would take that. But here's the thing. Rob, have you ever heard VOO and chill?
Oh, yeah. VTSAX and chill. I've heard a few others. Yeah. But yeah, VOO and chill. Sure. Mm-hmm.
So like you could you could theoretically own this one ETF and just say, you know what, I'm going to own this one ETF. It's tracking the S&P 500 and I'm fine with that. The problem is the S&P 500 is always evolving. And right now it's evolved heavily into tech, which is what David Durkin is getting at here, is that you're not actually owning a well-diversified portfolio at the moment. You are owning a lot of tech sector, and just as much as an impact it has on the positive aspects of maybe your portfolio growth, it could equally have a significant impact if for some reason the tech sector suddenly plummeted. And if we take a step back or three of what an ETF is meant to do for you in terms of diversification in itself, by definition, is meant to shield you to a certain degree from those various elements of certain sectors, certain regions, certain company sizes as a whole, having a significant impact on your portfolio. So if suddenly you think that you've got well, at least in this case, you've got a U.S. large cap fund, that's what it's meant to represent, but actually it represents the U.S. large cap tech fund, you are potentially exposing yourself to more risk than you think you are.
Omen, I'm going to take your point. First of all, I'm going to play devil's advocate, and then I'm going to take your point and run with it. Okay. So now you kind of talked about the VOO or any S&P 500 ETF or mutual fund. Okay. And you spoke to it as almost like it's its own thing. You spoke about the inherent diversity in it. I think that's important to note. This isn't one investment. This is still 500 investments. Mm-hmm. Okay.
Yep.
Now, to your point, it is 35% tech right now. Even more so, it's heavily weighted towards that. Like the largest companies in the S&P 500 are tech, right? So 35% tech within the S&P 500. It doesn't bother me as much as I think maybe it bothers maybe you or this author, because right now that's just the shape of our economy and where a lot of the development is happening. So to me, that makes sense. However, if you look back to 2000, the S&P 500 was 33% tech. You remember what happened then?
And what happened? Yep.
Right? It popped. And for a more sane benchmark in 2010, tech compromised 15% of the S&P 500. So there's an argument to be made here that maybe perhaps it's over tech weighted and that there's a tech bubble again, which, AI, sure, I wouldn't be surprised if there is. But also take comfort in the fact that there's the rest of it, the other 65% isn't tech. And those are all of the largest companies in the United States, most successful companies that are still within it. So yeah, is a correction coming? Probably. Is it catastrophic? Probably not. But if you're worried about it, what do you do?
The number of ETFs you own is the number of levers you have. If you are somebody who says VOO and chill, and that means you only have one lever. And so you are automatically taking on the risk of this one ETF and its performance, good, bad, or otherwise. And you don't really have a lot of flexibility in that. On the flip side, you could own 20 ETFs, and you could own an ETF that is, maybe focused in on a number of different areas. It could be regionally, it could be by sector. I mean, you could have large, mid, small, international, US, ex-China, global. I mean, there's all kinds of different ways that you could split this out and give yourself 20 to 30 different levers. Arguably at that point, the number of tweaks that you have to make when you're shifting those levers might get a little bit complex. So, there's got to be a middle ground that you're comfortable with of the number of levers that you have that minimize the risk that you're taking in perhaps just owning one ETF. So maybe you do own VOO, but to mitigate the risk of some of the tech heaviness of that particular ETF, now you own a mid cap or a small cap or a blend somewhere that focuses in on something other than tech. So, these are just ways to think through the amount of risk that you're taking, noting that like all things look good right now for AI and tech. Like if you might be listening to this, you're like, Omen, you're out of your mind. Like I'm doing my portfolio is doing awesome. I love this. Come talk to me in a year or 2 years or 3 years when things start to turn downward. I can't predict the future, but I'm just assuming at some point something has to give.
It's an excellent primer to what we're about to talk about in the meat of the episode. Okay, because what your expectations, what we've realized, what's happened in the S&P 500, the growth of tech, the growth of AI, and what we've realized over the last 10 years, and just that feeling of momentum. And also like AI is here to stay. Okay, cool, but is it going to be valued as much as it is currently? Or is it as much, venture capital going into it in the future? Who knows? So what's it going to look like? I do, again, want to play devil's advocate and then run with your point. And then I promise we'll get to the episode. But this is a perfect, appetizer to what we're going to talk about. So I do want to spend just a little time. So you talked about the VOO as one lever. The opposite side of that thought is it's actually 500 levers, right? Because each one, it's kind of like a self-cleansing thing. You actually own every single company in there. So someone that's a big fan of VOO or a cynic to what your point might say, like, well, it is inherently diversified. And sure it is. But to run with your point, if you do seek a further diversification, first point is if you want just tech, there are indexes for just tech. Was it QQQ, right? That's tech, that's NASDAQ, right?
Yep.
So not a recommendation, obviously, but I mean, it's just an example that there are plenty of options for you if you want that sector specifically. Once again, I turn your attention to the Callan periodic table of sector returns or investment returns. Search it up, CALLAN. It will show you the exact same thing that Omen just talked about. That, yeah, it's been great for a while, but it hasn't always been forever. And the S&P 500, it might be the number one investment for the next 10 years. I don't know. You don't know and no one knows. But it could be international developed. It could be commodities, probably not. But I mean, it could be metals. You just don't know what it is. And that's why we like to look at these different sectors and different indices and maybe match them in a way where like, hey, we're capturing emerging markets. We're also capturing the S&P 500 and we're capturing small cap too. These low correlated sectors that I like to put together for my portfolios. Anyway,
Before we get into that though.
Yeah, go ahead.
Yeah. Well, of course I've got an argument here because you can say you've got 500 different levers in the S&P 500, but how many of those levers can you control?
Right.
You can only control the one that you own that ETF and how much of that ETF you own. That's your control. But somebody else is behind the curtain pulling all the levers for you. And if they're pulling them in a way that is focusing into areas that takes more risk than you're willing to take, it's important to know what is in your portfolio. So even if you're not having somebody else manage it, like have a look at your overall portfolio and where it's weighted. And if something looks fishy to you, like, oh man, this 35% in tech, that's kind of weird. Like, figure out what's the ETF or what are the ETFs that are making it that way and start shifting things around. Maybe sell a little bit off of that particular ETF and buy into something else, or however you want to fix this with risk. But the point is, you've got those choices to develop your investment plan in a way that takes the risk, either weights it into one area or reduces it in different areas. But those are your levers, not the levers within the ETF itself.
Yeah, that's a good point. But I mean, well, now you're driving me into a conversation.
All right.
Well, we'll go along. Who cares?
Yeah.
Well, the levers are automatic, though. There's no one deciding which company falls out of the S&P 500. It's automatic based on their returns. And,
but you don't have any control over that.
No,
you don't have any control over that.
You are correct, but no one else does either. Like, there's not an active fund manager. And so...
But you have control over how much of it you own.
Of the ETF, sure.
Yes.
But
yes.
Right, yeah. But the argument for the index funds is they're inherently self-cleansing, and it actually has the built-in discipline to, spoiler alert, so it kind of like saves you from reacting to companies going up and down. Because if they fail and they go down, then they're just off the S&P. You're not invested in them anymore. Or if they're growing, you've got them. And then your interest in them, the market cap weight of it increases over time. So I think we maybe view it a little bit differently. I think we agree on just accepting the volatility from the beginning of it. Mm-hmm. Like you said, I think you just like identify the historical volatility and return of that. Yeah. And then does this apply to me and what my goals are? So we agree there. I think just how we view maybe an index fund is slightly different.
Well, we can move on to the discipline of investing. I don't know if we actually disagree. I think it's just accepting the fact that a fund like this might have more volatility than you want to have in your life. But a lot of times people don't actually realize that until they look at what is going on inside that fund, and they have to kind of keep up with what's going on inside that fund because those levers are happening automatically behind the curtain.
Okay, well, that's a good point. And I agree with that. If you haven't looked at the historical volatility returns of these things, then you might be in for a surprise regardless of the reason, if it's tech or any other thing. Yeah. So go check it out. I'll link the article in the show notes, but in the interest of time and more probably interesting conversations ahead of us here in the next hour, I'm assuming, let's go ahead and get into the meat of the episode. As we talked about before, we're talking about today in discipline in investing and the reasons why it's so important to be disciplined in investing. We always talk about intentionality, flexibility, and awareness, but today we're talking about discipline and how that manifests in investing and why it's so important. So we got 5 points to throw out there and have a little discussion about. I imagine each one might drag on a little bit. That's okay, or some maybe more than others. But we've got 5 ideas we want to get into and talk about why this is so important. No further ado, let's just go ahead and jump right in. Point number 1 about discipline in investing. And that is, let's just talk about what is investing discipline actually. Let's just go ahead and define it. Let's talk about what we're talking about specifically in discipline in investing. Omen, you talked about, I guess, the results of our investments with the VOO in the article. And a lot of times when that happens and we haven't thought ahead, we haven't looked ahead at what this investment is intended to do, when it starts to behave the way we know it will probably behave, it brings emotions into it, right? And being disciplined in investing is not about not having those emotions. It's about how we behave when we experience those emotions.
Yeah, I mean, there's a reason why it's actually called VOO and chill, or VTAX and chill, or whatever you want to say. It's so that you don't have to worry about it, because the known is that the market is going to behave in a way that it goes up and it goes down, as businesses not only have some kind of defined value, what people actually think of that business value is going to assign a number that might be irrational. And we know that already about the market. And so you're going to see these odd behaviors within the market itself. The fact that you can select an ETF and quote unquote chill after that is that mindset of knowing that the market is, you're going to purchase this ETF, the market's going to do what it's going to do, and you can chill out. You can just let it run its course and you're still going to be okay. That's the whole point of it. It ignores, or what's probably a better way to put it, it provides you a system in which you can fall back on that helps you to mitigate any kind of behavioral influence on your investments.
There are 3 ways here we have outlined about dealing with the emotions of the market, right? It goes up, it goes down, and how you experience the market. There's 3 behaviors here that I think are really important. And 2, I would argue, are actually a subset of the first one. So the first one, investing consistently. All right, we'll talk about dollar cost averaging later, but just being consistent, making a decision and consistently investing based towards your goal, right? Investing consistently in the market that we know provides value over time. Now, joining that, or maybe a subset of that, these 2 things, not selling when things get scary, when the market tanks, when it goes down, when that 35% bubble of the VOO pops, not freaking out and dropping out and selling everything. And also not chasing returns. In other words, like what the hot thing is, or if you haven't been as weighted in the S&P 500 over the last 10 years and you've seen the 15-point return annualized, and you're like, oh my gosh, now everything has to be in it. All right. So those are the types of behaviors.
I was going to say, should we go back and say that 15.5% annualized return on VOO was not an endorsement to go buy VOO? No. So don't chase that return.
Yeah. I think we're safe just saying facts. It's fine. I mean, it's a good disclaimer. But yeah, the main point is that's just, we've gotten lucky in that part of our portfolio. Right. The same could be said for gold. We've talked about that before. Like it's been great over the last, I hesitate to say the exact time frame. Just recently, it's been really good. So you might be tempted. Okay, well now I'm going to sell all the S&P 500 because Omen said it was overweighted in tech, and Rob said gold had performed well. So now I'm going to go chase that. So that's what we're talking about. Don't freak out when it goes down, and don't chase the return.
I know I was like saying if we take a step back, but seriously, take a step back from what Rob just said on this, and it looks boring. Like,
oh yeah,
it is. This is a boring, systematic view of investing, of just consistently putting money into the market and letting it ride, like being okay with the ups and downs and putting your blinders on and just sticking with a plan that you have developed out of kind of a non-emotional state. And when the emotions start to get high, like turn off the news, go back, look at your plan. Is it still doing, are your investments still doing what you thought you wanted them to do? Are they still as risky as you want them to be? Are you still investing consistently? And then if so, just keep cracking on. It's boring.
Every time you say take a step back, my juvenile brain thinks of Tom Cruise in Tropic Thunder. You know what I'm talking about?
No. And I don't know if I want to know.
It's not safe for work. I'll just tell you that. Anyway, if you're a listener, then you're probably smiling and grinning. Anyway, this brings me to a question I have about discipline in investing. Let's wrap this up before we move on. Critically speaking, there's kind of 2 things we talked about. We talked about behavior so far, and we've also brought up the strategy. So what is discipline investing? Is it more about the behavior, or is it more about starting out with the right strategy and sticking to it? Which I guess would imply behavior, but is it the strategy or behavior, I guess is what I'm trying to say.
This is a chicken or the egg question, right? What came first, chicken or the egg? Because the strategy solves the behavioral problem, but you need the strategy because the behavior exists.
Good point. So, but I guess you need the discipline to stick to the strategy.
I just saw your face. You're like, I'm so confused right now.
I looked confused. I look confused often. So, yeah. To me, the line, and I wish I know who to credit this to, but the line, if all we needed was information, we'd all be millionaires with 6-pack abs. To me, it always resonates more as the behavior side. Obviously, you want to make the right decision and have the good information. Like, hey, this is what I'm sticking to, but you got to have the behavior to stick to it. So, but you're right. It's kind of one or the other at the same time. So anyway, moving on, not doing bad on time. Not that it's a concern. I know all of our listeners are loving our stupid banter. So why not draw it out? Point 2, talk about investing. There is an enemy, and the enemy is your own stupid brain, right? It's your own brain, your own feelings. Like we talked about the emotions, your behavior, it's your brain and how you react when market returns aren't as expected.
There's 3 cognitive traps that we always look at when it comes to investments. And we'll ask these questions of our clients too, right? Because we want to get a measurement of how people think about the market and its returns. So number one is loss aversion. So
real quick, can you just talk real quick about the cognitive trap idea that we're talking about individuals, right? We're talking about the investor and how they feel, right?
Oh, yeah.
Yeah.
Yeah. So, yeah, this is how you, as an investor, think about the market. And what it does is it gives us an idea, whether it's you or somebody who is investing on behalf of you, it gives us an idea of how to counter your feelings about the market in a way, like developing a system that helps you sleep at night, basically. So those cognitive traps, those individualized cognitive traps, is loss aversion. So feeling like losing feels worse than gaining. Recency bias. So the market just had a great year back in 2025 last year. So you think that the market is going to continue to have great years. And so you invest like that. Could be a bit risky. And then finally, herd mentality. Everybody is doing it, and so I should do it too. It's FOMO. So these three cognitive traps will help us understand. If we can understand how you feel about those traps, then it helps us to build systems around those traps that will help mitigate the risk of you either, one, losing more money than you want to. So that sounds like reduced risk to me. Or two, recency bias. So making sure that we're thinking realistically about what the market could be doing. And then three, herd mentality. We don't really care what everybody else is doing. What is your risk tolerance and how do you feel about investments?
This is great because it helps you just understand yourself and arms you to identify it when it happens. Yeah, so if you've gone through this and checked out what your cognitive trap might be or your bias might be, when the loss happens or when an exceptional gain elsewhere happens or when one of these things happen and you start to feel it, instead of inspiring you to act, you'll be like, nope, this is my thing. This is my hang up, right? When like we talked about, I'm not really eager to spend my emergency fund when I should be. Right. That's my cognitive trap. I have this like, I don't want to lose it. I built it. And he's like, well, this is what you built it for. And I'm like, yeah, but I have this cognitive trap of using it for it. So just understanding your cognitive trap just helps you make better decisions in the moment. That's a really good point. This episode is brought to you by the Military Financial Advisors Association.
MFAA is a global network of independent, fee-only fiduciary financial advisors who specialize in serving military families.
And we're not just highlighting it. Omen and I are members ourselves, so we know firsthand what they stand for.
That's right. Every member of MFAA is either active duty, a veteran, or a military spouse, so they truly understand the unique financial challenges that come with military life.
Plus, every advisor must hold or be actively pursuing the CFP designation, which is the gold standard in financial planning.
But let's put that together. When you choose an advisor with MFAA, you are getting a professional who won't sell you a product, who knows the military life, and will plan using your hard-earned military benefits.
Whether you're navigating a step out of the military after 4 years, a military retirement, or a transition into a work-optional lifestyle, MFAA advisors speak your language.
Visit militaryfinancialadvisors.org to find an advisor who fits your mission.
MFAA, real advice, real experience.
This advertisement is for informational purposes only and does not constitute financial, legal, or tax advice. All investing involves risk, including the loss of principal. Information and opinions provided within the fiscal foxhole do not necessarily reflect official positions or opinions of the Military Financial Advisors Association or its members. Consult a qualified financial professional before making any financial decisions.
Rob, I can say that this is very similar to what the military does in all of its training. Anyway, they try to put you under as much stress as possible in various situations. This is quite literally, I always thought that this is weird. I thought this is a Marine thing. I don't think it is, where if you're on the rifle range, and have you ever had to, well, I'm not going to ask you that. When you're pulling butts. No. When you're pulling butts down on the rifle range, right? So you are the guy who is pulling the target down and pushing it back up. You're marking the target where the shot went through. It always makes for a miserable day when you're down in the butts. But what it does is get you used to what it sounds like gunfire hitting over your head, because the gunfire is quite literally snapping right over your head, and it gets you used to that. You start to know what it feels like to be under a little bit of pressure, having rounds go over, dirt, like somebody's low shot hits the dirt right over your head and you have it sprinkle all over. Understanding what that stress does to you in that moment helps you make better decisions, because now you know how you're going to react. These kinds of questions, when we talk through these cognitive traps in the market, the questions themselves can't really put you under that kind of stress, but maybe helpful is when the market has a downturn is to then reach out really quick and ask yourself, how am I feeling about this situation? Am I afraid of losing money? Or did I just hear about QQQ, so I'm going to go buy it because I heard it was a good thing to have? Or like, I can't lose. The market is doing great right now. If you're having these kinds of emotional reactions, know that about yourself. Mark it down, write it down.
Well, in the Army, we don't put soldiers downrange.
I thought you do nothing but put our soldiers downrange. Or is that just your reservists?
What was your ASVAB score? You can hold this target really high over your head. I have this image.
Brother, you are not immune from this stuff. Like, the Marine Corps is savage. They're like, you got a GT score of a 136? Don't care. Like, you are going to be crawling under the wire.
I love that. The whole time I listened to everything he said. It was really, really good information. But the whole time I just pictured you standing like, 100 meters down range, holding a target over your head, like wincing with your eyes closed. I couldn't help it. Oh, I hate my brain. Speaking of stupid things, have you fallen victim to one of these cognitive traps before?
I'm sure I have. And some, like, oh, I wish I would have. I think it's more in retrospect than anything, but I don't think I've.
Yeah,
brother, I've lived a boring investment life. I'm sorry.
Well, that's a good one. There's no shame in that. I do have one quick story, and that's back in 2018, 2019. I did get into some individual stock investing. Just kind of for fun. This is my cowboy account. In other words, like not part of my retirement, any other goals, just like, hey, let me just have some fun in the stock market. I ended up buying this pharmaceutical stock that was local here in Maryland, which I did read about and I liked, and they were doing all these different trials coming up. So there was a high upside potential. It was a borderline penny stock. Like, I think it was trading at like $2 a share, but it had a lot of potential and I liked it. And I bought it. Now I'm not talking about like $1,000, but like maybe 100. It was a good amount. Anyway, real quick, I held on to. I watched it waver up and down, and then one morning when I was making breakfast for my kids, I lost 80% of it within 10 minutes. Literally checked before I started making breakfast. After breakfast, one of their trials had failed. An RSV vaccine trial failed, and it was gone. And now it was down to like 20 cents a share, 25, 22, really, and I held on to it. So then it became like, what's the bias where you hold on to something, that emotional, like, I held on to it because then like, anyways, I had an emotional connection, so I held on to it. And also I'm like, well, it's not worth anything. Why not? I'll just hold on to it. And I watched it fart around for like another year or so. And eventually I'm on to other things. I'm like, I'm gonna just sell this junk and then I'm going to buy something else. Then COVID hit and it came out with a vaccine. It was up almost 3,000% in 2020. And I was not on that ride. So I fell victim. But this is day trading. Like, this is kind of what it is. Like within it, you could fall victim to 2 or 3 different cognitive traps and biases. And the stock price doesn't care about how you feel about it. Like that is your experience as you're doing it. And it can harm you. I do have success stories, but that's my biggest black eye from back in the day when I used to do that stuff. Anyway. Okay, let's move on. Point number 3 with discipline in investing is dollar cost averaging, the boring superpower. Returning to your theme, talking about boring and how it helps us out. Dollar cost averaging is one of the most ubiquitous, easiest, friendliest, one of the best ways to be disciplined in your investing.
Yeah, I mean, it is another habit to get into. It's easily systematized, and there's a dark side to this, right? Like, I didn't want to really bring this up, but I will now, is sometimes you can get into this habit and it's hard to get out of this habit when you get older and it's time to start withdrawing, like distributing your retirement accounts. You're like, well, I've been saving for my entire life. It's a great habit to have, but not in your 70s necessarily. But for investment discipline, this is basics. I mean, this is fundamental.
Yeah, it's systematized, like you said, and it's really helpful. It's built into 401k, TSP, 403b, those automatic when it takes it out of your account and invests it for you regularly, month to month. Now, there's a benefit to that, Omen, investing every single month, 12 times a year or 26 times a year or however you get paid. And that is benefiting from different movements in the market over that time.
Exactly. So when whatever your retirement fund is invested in, at the price, you're going to capture the price of that every single time you invest. It could be a low price, could be a high price, but that is the point of dollar cost averaging, is that over the course of your investment, you are capturing that price at both its low points and its high points.
Right. And that's the averaging part of dollar cost averaging. Because, ideally you would love to buy all the lows, but the problem is you don't know when those lows are going to be. You have no idea.
That's right.
The market could go up the entire year and you could be waiting for the low. And now you missed out on all of the gain because you were like, I'm going to wait for the low. What dollar cost averaging does is it averages out your price. So you're not going to get the lows. In fact, you're guaranteed not to buy during the low in the year, but you're also not guaranteed not to buy at the highest part. I mean, you might once. Right. But you're 11 other times you're buying either lower, the average, or at the low. Right. So it averages out over a year. It gives you that guaranteed average price of the investment over the year.
And the thing is, you're never going to, like you said, Rob, you're never going to know where the low is until you get to the end of the 12 months and look backwards and say, oh, yeah, I bought it low in February, April, and June. Like you're just not going to know that. You are actually buying in at the low until you look backwards.
Now, Omen, I've heard this question before. What if the market's been on a tear for a sustained period of time, and you've listened to the Fiscal Foxhole and you've heard us say like, oh, it feels like a correction or recession is looming out in front of us. So if you have that prediction, if you have that feeling, how does dollar cost averaging help you, or should you pause dollar cost averaging and just kind of wait for that to happen and maybe build up a reserve to invest, when it happens? What are your thoughts on that?
So this to me is another behavioral cognitive bias. If you think that the market is going to do something and you pause because you think the market is going, we do not know what the market is going to do. And if you use dollar cost averaging, even if you buy at what you believe is going to be a high point and know that you're going to, or think, I should say not know, you think that the market is going to suddenly correct and you are going to lose the very money that you just put in, your next set of buys is going to be at a low point. It's the dollar cost averaging. I think we have to get away from this idea that we know what the market is going to do. If we knew what the market was going to do, you and I would be out of a job, Rob. Like, we don't know. Our whole, like, when I think about how I manage investments for people, what I manage, like the investments I actually manage, is not the thing I'm managing. What I'm managing is people's behavior. It's to prevent exactly this of thinking like, I'm gonna pause my contributions because I think that the market is going to correct. When? Next week? Next month? Next year? I don't know, and neither do you.
Not only would we be out of a job if people knew what the market was going to do, or if we knew what the market was going to do, I wouldn't be doing this at all because I wouldn't need to.
I wouldn't either. Yeah, that's right.
I'd be trying to
house in Greece.
I'd be fighting every day until noon to make my first margarita on the island and wherever. Like that would be my job. So nobody knows. Just to hammer your point home, I asked this softball question because I knew you were going to slam it out of the park, and you did. Like, no one knows what the market's going to do. So the dollar cost averaging is your friend, and it helps you. Like, yep, okay, it's been up, it's up, it's up, it's up. And you're like, I'm buying fewer and fewer shares each time and less purchasing power. But guess what? When it goes down, now you are buying boatloads more share at the same price. So, and this saves you from it. Another really astute question I get around dollar cost averaging when I explain the benefits is someone who's been doing it or they believe in it, and then suddenly they have like a bonus that they don't need and they want to invest. It's, $10, $15, $20,000. And they wisely say, hey, if dollar cost averaging is such a good idea, why don't I just spread this out over the year? And I think that's a really informed, educated question. However, there has been research on this, and it shows that just get the money in as soon as possible. And because that wins out about 2/3 of the time. So if you have that bonus, you're worried about this, like just get it in. Because also that's kind of what dollar cost averaging does. Because let's be honest, we're talking about your paycheck. When your paycheck hits, you allocate 5-10% towards your 401k or TSP, you're getting that dollar cost average action. And that these are just all the benefits of it.
Yeah, I would say, and I hear you, Rob, but I would say I would have a conversation with the person on the other end before they invest fully a $50,000, $100,000, or whatever at one time in the market, just to get an understanding of how they might feel if the market suddenly loses 20%, 25% the day after they invest that. Like, the last thing that I want to cause in some investor, I still want them to be able to sleep at night. So if breaking this up into $20,000 chunks every month for the next 5 months makes sense because they'll be able to sleep, I'm actually okay with that.
Okay, I think maybe if I could take your point and kind of refine it a little, I think what you're talking about is just understanding what we're investing for, and that can be just general wealth growth. Like I have some clients where we're like, well, this is invested for this is invested for this, and we have a bucket here that's a little, we don't have anything tagged to it. We're just like, well, this is just general wealth growth, right? And that's okay. We just have to identify it. And to answer kind of your question of like, are you okay if it goes down? The answer is yes, because we haven't tied it to a house down payment or a child's education. Right.
Yeah.
But I would still, I mean, I would be on the other side of that. I would still encourage like, what are we waiting for? Because if it goes down, like, well, what if it goes up?
Yeah.
Yeah. So
yeah, absolutely.
I think there's even fear. So I would let's just get in the market and be okay with the results because we've identified whatever investment it is to meet whatever goal we've identified.
Yeah, no, I hear you on that. Again, I think I would take a cue from the client on this one. I would still encourage them to get it in the market, but if by getting the whole thing in the market, even if you tie it to a goal, like we're going to use this money 10 years from now, so we actually don't need to look at it. We can put it all in, and if it loses 20% tomorrow, we're going to be okay with that because we don't need the money for the next 10 years. We're going to have that conversation. Absolutely. If by them still losing 20% of the market tomorrow is a realistic fear of theirs, I honestly don't see anything wrong. Like mathematically, and the chances are that their portfolio could gain. Yes, I see what you're saying there. I hear what you're saying. But if they do that over the course of 5 months, like that doesn't bother me. That's an optimization problem, not a make or break the plan problem.
I see. So we're talking more about suitability.
Yeah.
Which I understand. This is the time where Omen and I talk shop on the Fiscal Foxhole, but that's. I know I get your point. That doesn't make sense because you do have to know your client and is this good for you and right fit, of course. Yeah, good point.
But I think this is still important for the individual investor too. What you and I just explained of tying things to goals, yeah, absolutely do that. Because if you tie it to a goal that you're going to need that money in the next year, clearly your investments are going to be less risky. Like you don't want to suddenly go out on margins or something by option trading on money that you're going to need next year. You're not doing that. So the chances of you losing 20% tomorrow are significantly reduced simply because you don't own that much equity. However, just that going through these cognitive biases and the fears, again, if I think that as an individual investor, if I have this fear of the money without somebody kind of hand holding me into it, if I have this fear that the money is going to lose 20% or 25, 30% in the market over the course of time, where leading up to when I need that money, I don't know, putting it in a couple of months, spreading it out over a couple of months, again, to me is an optimization issue, not that will solve for some behavioral biases.
What if my goal is to 10x my money by next week? Then I need to jump in. I need to get on these options, right?
Wow.
Here all week. All right.
I've got nothing to say.
Nor should you. You should not have anything for that nonsense. Anyway, all right. Let's get this ball rolling again. Let's move on to point number 4. And that is staying the course during volatility. This is what to do when your account looks like a combat zone. When that volatility hits, when the up and down hits. I do want to take a moment and just talk about risk, okay? Because I think it's important that we talk about risk and what it is. Because I use the term risk very deliberately when it's needed, and volatility very deliberately when it's needed, or when it's appropriate, I should say. Risk when it's appropriate and volatility when it's appropriate. To me, with investing, the risk is not meeting that goal that we talked about. Not getting the kid to college, not having the down payment for the home. So we're investing in things that avoid the risk of not achieving the goal. All right. In the meantime, the up and down, before we need the money, before we're going to sell anything, before we're going to react, right? It's volatility, because you haven't really lost anything. Like it's all on paper. The goal is still out in front of you. And so long as you've picked the right investments for your goals, then the chances are you're hopefully going to still reach your goal. So it's less of a risk and more of just the ride along the way, i.e. volatility.
Yeah, I love how you frame that, because I was actually thinking about that just a little bit differently in that the risk is required.
Yes.
It's exactly how the market is designed to work, and it's exactly why we would invest money in the first place, is because the returns are dependent on the risk you take. So the only way to get larger returns is to take more risk. Whether or not that risk is appropriate for you that's a whole different issue. But I love how you frame that you tied that risk directly to the goal achieved. So it really gives you the ticks on the measuring stick of how much risk you actually have to take, because particularly with military retirees, if you've got a pension, you actually could probably take more risk because your fundamental income sources are as guaranteed as they're going to get. And so the only reason why you would need to take more risk is to produce more money. But do you need to take more risk? You could actually reduce your risk if you wanted to, because your goals are still going to get met. So I love how you tied that together. But I think it's important for listeners to understand risk is required. It's a feature, not a bug.
Yeah, and it's directly related to return.
Yes.
Yeah, and it's a fact, you can't get by it. So anybody, just an aside warning, actually there's a commercial that I see all the time now that's almost like implied return, like up to 10%. And they don't. Yeah. And I know in the disclaimer there's probably some acknowledgement of risk that you could lose your principal, but they don't talk about it on the commercial. It almost sounds like guaranteed 10% return for qualified investors. I don't know how it passes muster or compliance with regulators, but you should, anytime you hear something like that, you should know there is no investment that provides guaranteed return. Okay? Maybe the G fund.
If it's called an investment, that is an accurate statement. Has to be called an investment.
Right. Yeah. There's no investment that does that without risk. Right. And there's also no guaranteed return. And there's also no investment that provides return without risk, aside from the G fund, maybe. And even with that, there's risk that the government could fall apart. Right. So
yeah,
there is risk in every single one. So anything that implies to you, you're like, well, it's a guaranteed return, or it's supposed to do this, and there's no risk to this. It's like, no, it is inherent. If there was one, it would break the market. The market would collapse, and because it would be the only thing that's ever existed in that way, which has never existed and never will. So Sorry, I'm just now ranting, but I just draw you back to the volatility. What we're talking about risk with discipline investing, we're actually just talking about the ride. It's the analogy of like building a business. You and I, and we've seen this before where, you have start and success and it's a straight line. It's like, nope, that's not what it looks like. It's all over the place. It's peaks, it's values, it's multiple failures. And then all of a sudden a spike of success followed by a failure and then another growth. It's like, it's this wild up and down towards any goal, piano playing, starting a business, anything. It's not smooth. It's messy. Investing is the same way. So it's how you handle that. It's how you watch it go up, watch it go down, and just know that like, this is a feature. It's not a bug.
Yeah. This is why we talk through all these cognitive biases, developing the systems and creating consistency and understanding your own ability to take on risk. This is what I even tell my clients. If you are not willing to take on risk, meaning you can't sleep because of how risky your investments are, then it's time to lower your goals.
Yep.
Like we'll just reduce your expectations of what you're meant to achieve in the market. Because the last thing we want you to do is, the last two things we would want you to do is one, to sell in a moment of panic. And now it's not just a loss on paper, it's an actual loss.
Right.
And then two, to sit there in cash waiting for the moment to jump back in.
You realize that risk if you sell. If it goes down, that volatility, now it is risk. And actually, you've already suffered the risk and you've failed. Like you're like, okay, this is good. I'm good with it dropping this far. Now I want that. And you're like, I don't know, like galvanizing that loss. And this stretches back to all the way our first point. We're talking about don't react, don't panic, sell. Okay. There's a great part of an investment webinar I used to give. I still bring it up all the time with clients. And it's this study about the S&P 500 over the 20-year period from January 2003 to December 2022. All right. And the study found that if you took $10,000 and you dropped it in the S&P 500 in January of 2003, and you took a 20-year nap and woke up in December 2022, you would have $64,844 by doing nothing.
Wow.
Okay.
Wow.
Within there, in Omen, 20 years, how many ups and downs do you think there were?
Oh, yeah.
Oh, my God.
Tons.
Daily.
Tons.
Yeah, there'd be daily ones that would be down 2%, up 3%, down 1%. 08, 09. Yep. I mean, just terrible years. We're just watching it squander. It might have been down from your original investment from 2003. But if you just ignored it and you woke up in 20 years later and like, oh, I forgot about that account. Let me check it out. It's got $65,000 in it. All right. It's an annualized return of 9.8%. That's crazy. For 20 years, 9.8%. Yeah. Now, to illustrate a better picture of this, if you had missed the best 10 days, let's say you had the worst luck possible and you're like, okay, I'm going to try to pull my money out at the right time. I'm going to do it 10 times. Okay. And so you had the worst luck in the world and you managed to miss out on the 10 best days in 20 years, Omen. That's like 0.14% of the days. That's like 15% of 1% of the days. Yeah, it's like 10 days. The 10 best days of the S&P 500 for that same time, the same $10,000 investment would have been worth $29,708. Less than half. Because you missed the 10 days. You lost $35,000. Okay. Yeah. Now, when I present this and I talk about that, like you would have to have the worst luck ever to miss out on those days. I guarantee you a lot of people did, and here's why. All 10 days happened during 2008, 2009, or 2020. All 10 best days.
Right when people were selling.
Right when people sold everything because of the crash in 08. Guess what? Yep. 7 of the best 10 days of the last 20 years S&P 500 happened in 2008, 2009. And they missed out on all 7. And the same thing happened during COVID. They sold everything. They panicked. The other 3 of the 10 best days happened during 2020. It is very likely, not only did they miss out on those 10 best days, they missed out on a whole bunch of others nice days as those came back. Yeah. So anyway, I mean, if that doesn't illustrate the picture of riding out the volatility and being focused on your goal and not chasing returns, I don't know what will, because that really hammers it home. All right, moving on. Point 5. And this is about, we've talked about all the traps, This is about building your discipline system. This is about, okay, so now you, Omen, or the listener, now how do you build a system that can avoid all of these traps, biases, volatility, risk, and how can you be a disciplined investor throughout all of this?
Yeah, we are completely mitigating behavior here at this point by building systems. We talked about this on, I forget which show, that we talked through emotions and habit building and things like that. But your motivation level to do the right thing or not do something dumb will wane. So having systems in place that can catch you when you fall, it's critical to disciplined investing.
First step in this process, automate everything you can. You've preached about this
My
before.
favorite.
Yeah,
My favorite.
I'll let you run with it. I'll bring it up and I'll let you talk about it.
Yeah. When you automate things, there's no decisions to be made. Your money, when you set a percentage balance in your pay via MyPay, 5%, 10%, just to go to TSP every single month, you never think about it. And notice I said percent, not $100, $500. Set that percentage of your pay to go to the TSP, because what happens when you get a pay raise? You also get a retirement pay raise. You're now saving pay raise. So when you automate these things, you quite literally are not having to make the decision. Do I pause my dollar cost averaging? Do I wait to get back into the market? You don't have to do any of that.
How many of your prospects have come to you with doing that have already automated some things, and they just are like, I just feel like we should be doing more. We see what the market's doing, and we feel like our money should be, or we're doing more, or they feel like they're missing out in some way. What do you say to them?
It's the same thing that we've talked through on this episode. We take a look at what, oftentimes it's because maybe they aren't actually putting money aside into their TSP, or like maybe it's 5%, maybe we could bump it up to 10% or something like that. But otherwise, I think a lot of military folks have this attitude or belief that they aren't doing enough. But actually, when we can show them what is the result or what the projected result could be of what they are doing, they're like, oh, wow, I had no idea. I had no idea just putting a couple $100 in each month was going to potentially look like this in 20 years.
With that question, I was trying to kind of draw you in a different direction, but that's a great answer. But the other answer to that, what I was going to try to get to, is because they're doing this boring thing of the automation, and success in investing is just, it's boring. It's not flashy, despite the news and the noise. Like you're already doing the right thing, right? The next thing, and this leads us to it, is set the goal first. What's this intended for? Is it for retirement? Is it for 529? Is it for education? Is it for a down payment at home? Set the goal first, and then build the investing, the automated investing around that goal, because that's going to prevent you from being tempted to chase some other return. And I get this too. I do get people coming in, they're like, we feel like our money should be doing more. We feel like, oh, well, I saw S&P 500 doing well in the last 10 years. I just feel like, oh, we're not beating that. And I'm like, hold on, like, well, what are we doing? Like, what are we aiming towards? Are we aiming towards a retirement? Are we aiming towards this? Or are we just chasing returns because we've saw it on the news, or we've just seen it or heard it on a podcast that Bitcoin was up 16,000% in 5 years or whatever, when we set the goal first, then we don't worry about it. Like someone else might make a boatload of money in some new investment. Like, hey, good for them. That's great. But I'm investing towards retirement. That's my goal.
And I think tied very closely to that goal, we've already mentioned it, is the sleep test. Can you sleep at night with the amount of risk that you're taking to achieve that goal? If you find yourself waking up in the morning and the first thing you do is check your investments to make sure that, like, oh, wait, what was that, Rob?
Triggered.
Do we need to check your goals?
I feel seen.
Yeah, but seriously, this is a risk goal check. We want you to sleep at night. I want you to sleep at night, Rob. We want you to sleep at night. So if the amount of risk that you're taking is making you anxious, like you're thinking, man, I could lose it all, then it's time to it's time to reduce risk, time to reduce goals.
Yeah, and I get your point. You're talking about the reaction to what your investment does, the volatility, up
Or
and
what
down,
it could do.
or what it could do.
It's the worry about what it could do.
Gotcha. Or what's like maybe what it's doing now, and also what that indicates it could do. It could be even worse in the future. Yeah. I do check it every day, but I also feel nothing inside. So it's more about a curiosity than it is how I feel about it.
We already knew this about you.
I'm a good person. We're running with the bit. And
Did you just slam your fist when you said that? I'm a good person.
I'm a good person. Let me look at my mirror real quick. I'm a good person. Now, I know we run with that bit, but at some point I feel like I have to defend myself a little bit. Like I do have a heart. Anyway, but yeah, to your point, maybe have an outlined like once a year check-in, because you might be freed up to like, oh wow, that grew a lot more, and with the acknowledgement that it might regress to the mean in the future. But in other words, you might have the opportunity over 10 years to like, okay, well, wow, I've saved enough. Like if this continues to grow at its average rate, then I'm going to be okay. Maybe I can reduce my savings or something. Like that annual check-in's probably good. Maybe twice. I don't know. Whatever works for you. Like you said, that sleep test. Are you sleeping well, comfortable with your investments?
I think closely tied into that check-in cycle that you just talked about is writing this all down. Rob, you and I have talked on this show a few different times about the investment policy statement. And your personal investment policy statement could be a page, it could be 10 pages, but it's a contract that you're making with yourself about how you feel about investments, what you're invested in, what are the goals that you're investing for. You're outlining the structure behind your discipline in investing. And whenever you wobble a little bit, you can always go back to that IPS and say, what did I say I was going to do, or why I'm doing what I'm doing? And one of two things can happen at that point. You can say, look at the IPS and say, yes, I planned for this. I'm just going to hold the fort and we're going to keep doing what we're doing. Or you're going to say, you know what? I was a bit wrong about myself. I think I'm not as risky as I thought I was, or I don't have this goal anymore. Something might change, but at least you're having to process those emotions via a piece of paper that you've systematically put in place to help guide your investments versus just an off-the-cuff freak out of, I'm going to sell to gold right now.
I have 2 points to bring some more comfort to this. If you're someone that does worry about the volatility and the risk inherent in the investments you're taking, number one, there is no return that beats savings rate. Okay? There is no return that will save you from a savings rate that is too low. We put it that way. So in other words, if you got the goal for retirement, we've identified the portfolio, the thing that gets you there is your savings rate. And that's going to make you more successful than anything. Spending less than you make, saving as much as you can or as much as appropriate towards the goal, that's what's going to get you there. All right, we've talked about return and behavior in investing. It's all tied to return. But just take comfort in the savings rate is the critical piece, is the heartbeat of all this that we haven't really talked about yet, but is also critical and inherent in the success towards your goal. That's comfort point number one. Comfort point number two is something, it's a tattoo I'll get right underneath awareness and flexibility. And that is, this too shall pass. It's my favorite things to say in life. And I think I've mentioned this before in the podcast. In good times, in bad times, in normal times, in bored times, in great times, this too shall pass. This great moment I'm having with my child right now, this too shall pass. Enjoy it. Really cherish it because it's going to be gone. That sunset, this too shall pass. Enjoy it. This tough time in this relationship, this too shall pass. This downturn in the market, this recession, this financial hardship, whatever it is, this illness, God forbid, not terminal, this too shall pass. And even if it is terminal, this too shall pass, right? It's one of my favorite things to say. It helps in investing so much because it just helps calm your thinking when everything is going up and down, when you've already made the decision to align that volatility towards your goals.
I've got nothing to add to that.
Well, with all that fun behind us, by the way, I feel like we could do this episode about 3 more times.
I think we probably are going to do it 3 more times.
We might
probably way more than 3.
Yeah,
because ultimately you have to revisit these things over and over again because it's hard. Like discipline in investing is hard.
Yep. Yeah, this is reminding you to go to the gym. You know, we want to be healthy, eat right, go to the gym, right? So good reminders. This is all good stuff. Really appreciate you breaking this down in such a detailed way. Made it easy to talk about. So, but with all that behind us, let's get into the trivia segment. This is the time of the episode. It's time to have some fun. Aside from the fun we've already had talking about all the nerdery nonsense, we get to put our calculators to the side and lob absurd questions at each other in the futile attempt to get them right and score a point, at which we will reveal at the end of the year how many questions Omen has gotten right and how many I've gotten wrong. See what I did there? And then, and if you've been listening, go back to January. You can start again if you haven't and tally it up. And we're going to pick one lucky winner that is closest to the tally, who the winner is on this trivia challenge for a prize. But today it is time for Omen to do his worst towards me. He's already grinning like a Cheshire cat, awaiting to lob some nonsense over my way and watch me flounder trying to answer.
I wish we would have been recording when I laughed at this question when it came up. This is such an awesome question. And if you get it, it is going to be the best luck you've ever had.
See your tail wagging from here.
Oh, this is fantastic because of what you did to me last week.
Yep.
I wanted to keep with the theme of the show of investing, but I wanted to tie it to America 250. So are you ready?
This is the mutually assured destruction that
yes.
we face every single week. We're like, do I really want to be this mean to him? Because this is coming back at me. So now I get my medicine. Yeah, go for it.
Here you go. Here's your question. In 1776, the same year as the Declaration of Independence was signed, Scottish economist Adam Smith published The Wealth of Nations, often called the founding text of modern investing and market theory. But what was the title of the much earlier pamphlet that first made Smith's core argument about disciplined, patient capital accumulation, published decades before?
I know this.
Was it A, he never published an earlier pamphlet? The Wealth of Nations was his first major economic work. B, the title, Considerations Concerning the First Formation of Languages. C, the title, A Dissertation on the Origin of Languages. Or D, The Theory of Moral Sentiments in 1759.
It's a long time. 1759. I like the title of the third one, or it might have been A, because when you said that like there was an earlier version, it like maybe it might have like incepted in my brain that I had learned about this, because I'm a big fan of all of that. I'm a big fan of like the invisible hand and, you know, all of those theories from the early economy of the United States and how it formed. I'm not confident now. I thought for sure when you read the answers, one would stick out. So unless this is a massive curveball and I'm just hallucinating myself, I don't think it's B or C. So it's a coin flip between A and D, and because it just feels like there was probably an early edition, I'm going to go with D and press my luck and see how I did. D.
This is my... Yes, I love this.
Is it A?
No, you did not get the answer. Oh. Yeah, it was A. He never published an earlier pamphlet. You are so on it. I love it when this happens.
Oh, man.
You got to go with your gut, man. I mean, I went with my gut last week and lost, but...
No, it was my gut was telling me there was one, and it was my brain that was like, don't trust, you're an idiot. Don't trust yourself. Like, dang it. All right. Well, I don't know what resonated about that, the way the question was formed. I'm definitely familiar with the writing that you mentioned, but I don't know why. Oh, well. Here's me unfolding my long donkey ears, wearing hee-haw, looking a little foolish, but well done and noted for the next time. Well, with that unfair ridiculousness behind us, that's going to wrap it up for today's episode of the Fiscal Foxhole, where we come at you every week with all types of military-themed financial education, entertainment, and general nonsense. As I mentioned at the beginning of the episode, if you found this useful or you think a friend could use it, please give us a review and share it with a friend. We talked about a lot today, but so it's going to be a challenge for you, Omen, to break it down. But with that, please bring us our 3 takeaways.
first key takeaway is diversification is not about how many investments you own. It's about what drives your returns. Before adding more funds, make sure you understand what you already own. Our key takeaway number 2, successful investing isn't about predicting what the market will do next. It's about building a plan you can stick with when the market does something you didn't expect. And then our key takeaway number 3, the investors who win over time aren't usually the smartest or the most aggressive. They're the ones who build a system, automate the right habits, and stay out of their own way.
We'd love to hear from you. If you have questions you'd like answered on the show, please send us a note to fiscalfoxhole@gmail.com. If you heard something today that you'd like to discuss further, or you just want to dig deeper into your own financial game plan, both Rob and Omen are accepting new clients and always happy to chat. You'll find the links to their websites or to book appointments in the show notes. Rob Moore and Omen Quelvog are both registered investment advisor representatives. This podcast is for educational and entertainment purposes only. While they are both advisors, they are not your advisors. Therefore, nothing you hear on Fiscal Foxhole should be taken as specific investment, legal, or tax advice. For guidance tailored to your situation, please consult a qualified professional who understands your individual circumstances.
As we move into our off-duty segment, Omen, as we've talked through everything on this episode, been distracted the whole time. I've been excited to hear about the wedding rings that you teased at the beginning. So now's the time, buddy. How bad was it?
You know me. I'm a very serious person. This actually was not a joke. So I wrote the script to the wedding. I wanted to make sure that it was... it had a few jokes in there, and
just to clarify, you just in case someone didn't listen to the last one, you were the officiant at the wedding.
I was the officiant.
So when you talk about the script,
I officiated the wedding.
Yeah, you talk about the script. You're talking about what you said as you presided,
right?
Yeah,
and I did not write into the script thanking anybody for joining us for the Fiscal Foxhole. I did leave that out, but I had a difficult time, as one might, marrying their own child. That I just got emotional. Even reading through and rehearsing the script, there was one section where I was just struggling to get through. And it was right before the rings. And for some reason, the bride did not want the best man or the bridesmaid to hold the rings. She wanted me to hold them. What we neglected to figure out was how the rings were going to get to me before the wedding. Oh yes. No. So I am page 3 into the script. We're rolling. And I realize I don't have the rings.
That's not funny, man. I would laugh.
I don't have the rings.
I was excited to hear this story. That is not a funny story. I am sorry. Oh my God.
So I'm pretty sure I held it together. I'm waiting for the video because I want to make sure, but I'm pretty sure I held it together. And I continued down the script. Fortunately, what I knew was coming up was a 4-minute song. It was towards the end of the script. It was after the rings. But knowing what I knew, I got to the portion just before the rings, and I flipped the script and introduced the song. It caught the DJ off guard a little bit, and I was okay with that. But I got the song playing. And then I leaned over to the bride. I said, I don't have the rings. I don't know where they are. She kind of freaked out a little bit in the moment, but then remembered where they were. They're up in the groomsman's suite. I don't know how they got there, but they were there. I turned to my side. The best man was my other son. And I said, Isaac, I need you to run as fast as you possibly can up to the groom's suite, grab the rings, and get them back down here. When I tell you, 1, I've never seen my son run that fast. Number 2, Like 4 minutes of the song ended, and I had my left hand behind me, and rings appeared in my hand at 4 minutes.
Oh my gosh.
Put them back in my jacket, flipped the pages back to where the ring script was, and we went on with the ceremony as if nothing happened.
Oh my gosh. That's some Mission Impossible stuff.
Pro level.
Dude. You know, I actually, one of the things I admire the most about that story is you had the awareness, or I guess the thought to not go get them yourself. That would have been the first thing in my mind of like, I got to go fix it. I have to go do this. I would have run off. And then I would have been up in the groomsman's suite, been like, wait a minute. I'm critical to what's happening out there.
Oh yeah. I had to run the show.
So for your thought to like, I'll grab Isaac and send him to go grab it. That's pretty good. Oh, sorry. There's more. Go ahead. Yeah.
Guess who didn't get emotional during that part of the script? Because I wasn't even thinking about that script. I was just reading, and my mind was off like, okay, how do I get these rings?
Well, I don't mean to like poke a hole. So did you get to still also enjoy emotionally kind of like being in the moment too? Or did that unfortunately kind of pull you out of it?
I think it, to a certain extent, pulled me out of it a little bit. But like for me, I think that adds value. The whole situation adds value to the wedding ceremony itself, that is a story that they can now tell for the rest of their lives, that we didn't have the rings. And so we filled in all the details afterwards. So the bride and groom now know exactly what happened or didn't happen. But yeah, I think it was a value add.
When it became apparent that the rings weren't there, i.e. you told, I'm sorry, what's your daughter-in-law's name? We told the bride.
Elena.
Okay, when you told her, and then you told Isaac to run, who was glaring at you harder, your daughter-in-law or Megan?
Megan had no idea.
Oh, no clue. Okay. Yeah, I thought she knew.
Nobody, we tried to keep this on, we tried to keep this as hidden as possible. During that song, people were praying. So a lot of head down, eyes closed. So they didn't even see me. Like I walked around to the DJ and just kind of gave him if these rings don't show up in 4 minutes, I'm going to have to dance.
Yeah. Go YMCA, pull up the YMCA.
Yeah. Exactly. So not a lot of people saw me do that and make my way back. So yeah, it was not a lot of glaring because not a lot of people knew.
If everyone would please bow your heads again.
Yeah, just keep them bowed.
What's over there? Look,
keep praying. Why aren't you praying?
Is that a duck riding a horse over there? Look. That's crazy.
Dance, monkey. Dance.
What a great story. That's awesome. And you mentioned in the earlier one that everything was great. There was a beautiful wedding and everything went off well. But so that I assume that was kind of like the only, or maybe the biggest wrinkle, hopefully.
Yeah, I can't actually think of any other wrinkles. The rest, everything else was great. And even that wasn't bad.
Well, congratulations again. Thanks for sharing that. And congratulations on your expanding family. What a beautiful thing.